We've got quite the stack of material you sent over. Looks like a real deep dive waiting to happen on private equity NAV lending.
Yeah, it's definitely a hot topic.
And for you listening, you're clearly interested in getting, beyond the surface level here. So our mission today is really to cut through the jargon
Mm-hmm.
and understand what this NAV lending trend is all about and, well, why it should probably be on your radar.
Exactly. Think of this as your accelerated path to understanding private equity net asset value lending. We've kind of synthesized the reports, the legal takes, investor insights,
Right.
all the stuff you shared to really pull out the essential knowledge. What it is, why it's gaining momentum, and the critical angles to consider. That's the plan.
All right, so let's nail down the definition first. From the sources, it seems pretty clear we're talking about loans made to private equity funds.
Right, to the fund itself.
And they're secured by the value of their equity investments in private companies. And just be clear, we're specifically not including NAV lending against, like, infrastructure or real estate here. That's a crucial point, yeah. We're zeroing in on PE funds leveraging the net asset value, the NAV, of their portfolio companies. One of the docs, Funding Flexibility, actually has a good visual. Display 1.
Oh, yeah.
Yeah, it shows the NAV lender giving capital to the PE fund, and the fund, in turn, holds stakes in a bunch of different businesses. Pretty clear structure.
Okay. So maybe to appreciate the context fully, a quick refresh on the typical private equity fund structure. That seems useful.
Good idea. So looking at the net asset value financing paper, it outlines the familiar setup, limited partnerships.
LPs and GPs.
Exactly. Overseen by a general partner, the GP, usually the private equity firm.
Yeah.
And they typically have that initial investment period, maybe up to 6 years.
Right, buying company.
Yeah, focused on acquisitions. Then after that, it shifts more to managing those companies and eventually selling them.
Yeah.
Exiting. And the GPs get paid through the management fee, like 2%.
Usually around there, yeah.
And the carried interest, the carry,
Yes.
that classic 20% of profits above a certain hurdle.
The 2 and 20 model, yeah. And the fund's actual assets are those portfolio companies they've bought.
Got it.
And one thing worth noting, fund lifespans. They're getting longer.
Really?
Yeah, averaging 15 years or even more now, which, just creates a longer time frame where a tool like NAV lending might actually make sense.
Right. More time for things to happen, more need for flexibility.
Yeah.
Okay. So with that foundation, what's driving this increase in NAV lending? Funding flexibility seemed to really dig into the appeal for different parties.
It does. So for the sponsors, the PE firms themselves, it's really a compelling non-dilutive source of capital.
Non-dilutive. That seems key.
It's huge. They can use this cash to fund more growth at their portfolio companies, maybe make another acquisition.
Like a bolt-on.
Exactly. Or maybe just provide support to a company that's, struggling a bit. It gives them strategic options without messing with the ownership stakes of their LPs.
And for the limited partners, the LPs, what's the potential upside for them?
Well, the thinking is by providing that capital, NAV lending can help those portfolio companies actually reach more of their potential value.
Like in that acquisition example we'll get to.
Precisely. And ultimately, that extra value creation should, flow back as better returns for the LPs.
Okay. And the lenders. What's in it for them?
They like the potential for attractive returns combined with what they see as pretty strong downside protection built into how these loans are structured. We can get into that.
Right. And for, say, an asset owner listening in, maybe an insurance investor, why would they look at this?
Well, from their perspective, it's a chance to add a potentially investment-grade asset class to their private markets allocation.
Okay, so diversification.
Yeah, diversification, and something with maybe a different risk-return profile than, say, direct lending or high-yield bonds.
The growth numbers you mentioned are pretty wild, right? That funding flexibility piece had some big projections.
It really did. The global market, they think it could go from around $75 billion now to nearly $350 billion by 2030.
Wow.
Yeah. And just looking at North American middle market private equity, the AUM there has been growing like crazy, 14% a year since 2017, hit almost $1.8 trillion by the end of last year. Display 2 shows that.
So massive underlying growth, creating more opportunity. And that non-dilutive point really seems central. Firms get cash, don't give up equity.
Exactly. That's a massive advantage, especially later in a fund's life when they've already called down most of the LP's money.
Okay, let's unpack that downside protection you mentioned. What makes these loans potentially investment grade? What are the features?
Right, so there are several key things. First off, the loan-to-value ratios, the LTVs, they're usually pretty conservative.
Low LTVs.
Yeah, especially for the investment grade rated ones, often like 5% to 25% when the loan is made.
Okay, so that gives a big cushion if the underlying asset values fall.
Exactly, a built-in safety margin. And second, the collateral itself is diversified. Remember, the fund owns stakes in, multiple different companies.
Right, not all eggs in one basket.
Precisely. So that reduces the risk tied to any single company having problems. Like the paper says, even if a few struggle, just one really successful exit could potentially pay back the entire NAV loan.
That diversification helps a lot. And I assume lenders aren't just taking the PE firm's word on the NAV numbers.
No, definitely not. These loans come packed with pretty robust covenants.
The fine print.
Yeah, basically contractual safeguards for the lender. Things like if the fund's financials weaken or the LTV creeps up, the lender might get to sweep more of the cash flow from exits to pay down the loan faster.
Oh.
They might even have rights to challenge the sponsor's valuations if they seem, way off base.
So potentially lower risk, which I guess translates to attractive returns for the lenders, right? That's the trade-off.
That's the idea. Investment-grade NAV lending is targeting net returns around, say, 8% to 10%.
Which is pretty good.
Yeah, it's a nice spread, like 300 to 500 basis points over SOFR. And funding flexibility also points out, as of mid-last year, there was a nice illiquidity premium compared to just holding regular investment-grade corporate bonds, about 5.8% higher yield.
You get paid for tying up your money in something less liquid.
Exactly.
Okay, this is still a bit abstract. Can we walk through an example? Display 3 in funding flexibility, Henry.
Yeah, perfect. Let's paint the picture. Imagine a North American buyout fund. It's about 6 years old.
Okay.
It raised, say, $525 million, called $500 million from its LPs. And its portfolio of, let's say, 8 companies is currently valued at $675 million NAV.
Got it. Mature fund, decent value.
Right. Now, one of those companies, currently worth maybe $75 million, has this great opportunity, a $50 million acquisition that could boost its value up to maybe $125 million.
Okay, sounds like a smart move. But the fund's already deployed most of its cash, and maybe they don't want to load up that company with more debt or do another equity round.
Exactly the dilemma. So what do? They get a $50 million NAV loan. Let's say it's a 3-year term, SOFR, plus 600 basis points.
Okay.
They use that $50 million to fund the acquisition. Fast forward 3 years. The PE fund manages the bigger company well, and they sell it for $250 million in equity value.
Wow. So that $50 million NAV loan unlocked, what, $125 million in extra value creation? 250 volume sale, 125 BALR projected equals 125 LMA uplift enabled by the $50 loan.
That's the story the illustration tells, yeah.
Mm.
The NAV loan gave them the financial firepower, the agility to grab that growth opportunity.
Yeah.
And crucially, without diluting the LP's potential upside. If they didn't have the NAV loan option, maybe they missed the deal or have to use financing that costs the LPs more in the long run.
Makes sense. Okay, so flipping back to the investor perspective, if an asset owner, maybe an insurer, is thinking about allocating to this, what should they look for in an NAV lending manager? Funding flexibility listed some key things.
Yeah, it really comes down to a few core capabilities. First, you need a really strong sourcing network.
Deal flow.
Absolutely. These aren't always advertised deals. You need deep relationships with the PE sponsors to even see the good opportunities.
Right. Origination is key. What else?
Deep underwriting expertise. That's non-negotiable. The lender has to be able to really evaluate 2 things. The PE fund itself.
Track record, team.
Exactly. Track record, leadership, how they operate, governance. And then they need to dig into the underlying portfolio companies.
Understand the actual businesses.
Right. The industry, the risks, the company's own debt structure. And this is critical, really kicking the tires on the sponsor's valuation. Is it realistic?
So not just taking the NAV at face value. Independent thinking.
You absolutely need that independent view. Then you also need good implementation skills and flexibility.
Structuring the deal right.
Yeah. Structuring a loan so it works for the sponsor, lets them actually manage the portfolio, but also gives the lender the protection they need. It's a balancing act.
Adaptability makes sense in a market that's not standardized.
And finally, execution certainty. You want to partner with lenders who are really committed to this space.
Not just dabbling.
Exactly. They need established processes, a dedicated team, a clear risk appetite. It shouldn't be some side project for them. And maybe focusing on certain segments like middle market PE can be smart. Those areas often have better return potential because they're less efficient, more specialized knowledge needed.
Okay, so bringing it back to that insurance investor again. How does this fit into their overall portfolio? What's the thinking there?
Well, funding flexibility suggests it can be a really good diversifier, something that complements their other private credit stuff, whether that's focused on income or total return.
Right.
And you have to remember there's a whole spectrum of NAV loans out there. Display 4 shows this. You've got higher flexibility, maybe higher risk loans from non-bank lenders,
Okay.
and then more conservative, often in investment grade rated loans from banks or some private lenders who play in that middle ground. So you need to know where on that risk spectrum a particular loan sits.
And for insurers, those investment grade ratings are probably a big plus, right? Because of regulatory capital rules.
Huge plus. Yeah, insurers often have limits on how much high yield stuff they can hold. And the report points out that investment grade NEV loans get favorable capital treatment.
Lower charges.
Exactly. Lower risk-based capital charges in the US, lower Solvency II requirements in Europe, compared to holding unrated private debt. That makes a real difference to the economics for an insurer.
Those capital efficiencies matter.
They really do. But, you still want to be prudent. The suggestion was maybe limiting it to, say, 5% of the general account assets, treat it as a diversifier.
Sensible limit.
And again, it comes back to partnering with managers who really know what they're doing on the sourcing and the due diligence side.
Okay, let's dig a bit deeper into the mechanics. How are these things actually secured? That paper on collateral structures had some detail.
Right. So the collateral setup isn't always a direct charge over the shares of the portfolio companies. That can get messy with existing debt or transfer rules.
Okay, so what do they do?
Usually you see pledges of the equity interests in the holding companies that sit between the borrowing fund and the actual operating businesses.
So pledging ownership of the entity that owns the company, not the company itself.
Often, yeah. It can be a pledge of every entity in the chain, or sometimes, more commonly, just the equity in a top-level holding vehicle, or maybe an aggregator vehicle that bundles several investments. It's just cleaner, more flexible if things go wrong.
Simpler to enforce, I guess.
Exactly. Another big piece is usually a pledge of the distribution proceeds.
The cash flow coming up from the companies.
Right, a security interest in that cash flow. And almost always you'll have an account pledge too. The fund agrees to deposit all those distributions into a specific bank account that the lender has control over.
Got it. And what about promises the borrower makes, the covenants?
Yeah, lots of standard stuff there. Definitely a covenant saying all distributions must go into that pledged account.
Makes sense.
You'll often see covenants around the fund's uncalled capital commitments too, like needing to keep a certain amount available or maybe even having to call capital from LPs if there's a default, though that gets complicated if there's already a subscription line facility using that same capital.
Right. Can't promise the same dollar twice.
Exactly. Negative pledges are standard. You won't pledge these assets to anyone else. And sometimes a springing collateral covenant
What's that?
means if the LTV ratio gets too high, the fund has to automatically pledge additional assets to bring it back down.
Okay. More security kicks in.
Yeah. And depending on the deal, maybe guarantees from a parent entity or something similar. But the exact mix, it's tailored, depends on the borrower, how risky the lender thinks they are, what the assets look like.
Okay, but it sounds like this isn't universally loved. That NAV or never title kind of hints at some debate. What are the main arguments against or concerns about NAV loans?
You're right. It's definitely hotly debated sometimes, especially from LP perspective. One comparison that comes up a lot is with dividend recaps.
Dividend recapitalizations.
Right, where a portfolio company borrows money to pay a dividend up to the fund, which then goes to the LPs. Now, NAV loans are at the fund level, dividend recaps at the company level.
Different levels, yeah.
But both can be used to get cash back to investors faster.
And NAV or never mentioned a potential issue for LPs is that the NAV loan debt shows up right there on the fund's financial statements.
Exactly, it's visible. Whereas debt taken on down at the portfolio company level might feel a bit more hidden, perhaps, less transparent to the LPs directly looking at the fund's numbers.
Interesting point on transparency. And the other paper in net asset value financing drew a comparison to margin loans.
Yeah, it did, pointing out that while NAV loans aren't backed by liquid traded stocks, they might carry similar kinds of underlying market risks. Some people apparently see NAV loans as potentially, a bit risky, maybe a short-term play.
And there was a mention of systemic risk, too, especially with banks getting involved, similar to worries about subscription lines.
Right. Those concerns about interconnectedness always pop up when banks increase lending into less transparent areas.
Yeah.
The whole shadow banking system argument and how NAV lending fits into that definitely adds to the scrutiny.
Okay, one of the biggest hurdles seems to be just valuing the collateral. How do you put a reliable number on these private company stakes?
That is probably the fundamental challenge. The net asset value financing paper really highlights this. These are mostly level 3 assets.
Meaning illiquid, hard to value.
Exactly, no public market price. So you're relying heavily on financial models, projections, assumptions, which are inherently subjective.
And those assumptions could be, let's say, biased sometimes.
Well, there's always that potential, right? The risk of NAVs being massaged a bit. Maybe for marketing, maybe, as the paper suggests, to look better when trying to get financing. And we saw back in 07, 08 how valuation issues with illiquid stuff can cause big problems. Disputes can flare up, especially if the market gets stressed.
Yeah, valuation is key. But that same paper also laid out some potential benefits of NAV financing specifically for the LPs,
Yeah.
kind of countering the criticisms.
It did. It argued it can help LPs get their capital back sooner, which they often like.
Faster distributions,
Yeah.
DPI focus.
Right. And it can give portfolio companies the cash they need to execute on a sale or growth plan, which ultimately helps the investors too. An interesting point they made was that the NAV loan process itself might force a kind of third-party valuation check.
Ah, the lender doing their own diligence.
Yeah, potentially acting as a check on the GP's own numbers. And it can also give LPs a way to get some liquidity out of their fund investment without having to sell their stake in the secondary market, possibly at a discount.
Speaking of secondaries, is the link there too, right?
Definitely. NAV financing is actually becoming a really important lubricant for the secondary market, which itself is growing fast, especially for those GP-led deals.
Continuation funds and such.
Exactly. Where the GP wants to hold on to some assets longer, maybe roll them into a new vehicle, NAV loans can help finance those kinds of complex transactions.
Okay, so given all that, why would a PE manager choose a NAV loan instead of just having the individual portfolio company borrow more money? Navient or Never had some reasons.
Yeah, they pointed out that NAV loans can often be faster and easier to arrange.
Less hassle.
Kind of. The diligence is more about the diversified pool of assets at the fund level, rather than needing a super deep dive into one specific company's operations and finances every time. So operationally, maybe more efficient.
Okay.
And compared to putting, say, mezzanine debt directly onto a portfolio company, NAV loans usually have fewer, or maybe no, equity kickers.
Those warrants or equity pieces that dilute the upside.
Exactly. So the terms might be cleaner, maybe even cheaper overall, because the lender's risk is spread across the whole portfolio, not concentrated on one company, especially if single company debt would need cross-collateralization anyway.
It gives the GP more freedom, right? To move the money where it's needed most across the portfolio.
That's a big one, too. Yeah. The financing isn't earmarked for just one asset, more flexibility for the manager.
Okay, now, NV or Never did some modeling, which is interesting, trying to quantify the impact on LP returns. Let's look at their first case, using a NAV loan for a reinvestment in a winning company.
Right. They set up a base case. A fund reinvests in one of its stars using an NAV loan versus a scenario where they don't. They kept it simple, actually stripped out carried interest just to isolate the leverage effect.
Okay, and what did the model show happening to the fund's NAV and the loan balance over time?
Well, initially, obviously, the total money invested is higher in the NAV loan case because of that reinvestment. But the model showed the loan getting paid back pretty quickly, like within a couple of years. They assumed a cash sweep was in place.
So cash from exits paid down the loan fast.
Exactly. And then, by year 8, after the loan's gone, the scenario with the NAV loan actually had a higher remaining value because that reinvested capital kept growing.
Interesting. Short-term cost, maybe, but long-term gain in NAV. What about the overall performance metrics for the LPs?
The model suggested the levered scenario, the one with the NAV loan, generated higher overall gains, more total value created.
Higher TVPI, total value to paid in.
Yeah, higher TVPI by the end of the modeled period, year 10.
But what about actual cash distributions back to the LPs? Did they get their money back faster or slower?
That's where you see the trade-off. Initially, distributions were slower in the NAV loan case.
Because cash went to repay the loan first.
Right. But then when they modeled selling that big, successful portfolio company in year 10, the proceeds were so much larger in the levered case that it more than made up for the earlier lag. So by the end, the DPI distributions to paid-in capital was actually higher with the NAV loan.
So a bit of a J-curve effect on distributions, but higher overall cash back.
That's what the model showed, yeah. And looking at the overall return metrics,
IRR and MOIC.
the IRR, the internal rate of return, ended up being pretty similar in both scenarios in this particular model. But the MOIC, the multiple on invested capital, got a noticeable boost from using the NAV loan.
More total profit relative to capital invested.
Exactly. And the NAV lender in their model got a decent return too, about 1.2x MOIC, 13% IRR.
Did they look at how sensitive things were? Like, what if interest rates were higher or the cash sweep was different?
They did. And interestingly, in this scenario, the interest rate didn't make a huge difference, probably because the LTV was low and the loan got repaid fast anyway. But the cash sweep terms did matter more. There was a trade-off. A faster sweep paid the loan back quicker, which boosted the IRR slightly.
Time value of money.
Right. But it could actually lower the MOIC a tiny bit, because the leverage wasn't working for quite as long, less compounding from any PIK interest, for example.
Interesting nuance. And did they check the overall leverage level? Was the fund taking on too much risk?
Good question. They looked at the total portfolio LTV after adding the NAV loan, and in their example, it was still below the average LTV the fund had used when originally buying the companies.
So still within reasonable historical bounds, arguably.
That was the suggestion. Plus, the risk was spread across all the assets, not just piled onto one.
Okay, so the takeaway from modeling that growth scenario seems pretty positive for LPs, assuming the reinvestment works out. What about the other two uses they modeled? Rescue financing and just recapping the fund for distributions.
Right. For rescue financing using the loan to save a struggling company, the outcome was obviously very dependent on whether the rescue actually worked.
High risk, high reward potential.
Exactly. If the NAV loan helps turn the company around successfully, returns were better. If the company failed anyway, well, that was the worst outcome. You lost that extra capital.
Makes sense.
The fund distribution recap, just borrowing to pay LPs faster, that had the smallest impact on overall performance. It mainly just pulled distributions forward, which could give the IRR a little bump.
Time value again?
Yeah, but it didn't really change the total multiple much. The big conclusion across all three scenarios was pretty clear, though. The GP's skill in picking and managing investments is still the most important factor. The NAV loan is just a tool.
It amplifies the underlying performance, good or bad.
That's a good way to put it. Its effectiveness really depends on the quality of the investments and how well the manager uses that extra capital.
Okay, so wrapping things up. Never Never kind of positions this as the next step in how private equity gets financed. Can you expand on that idea?
Yeah, they made an interesting comparison to how unitranche loans evolved. Unitranche simplified debt for individual companies by combining senior and subordinated debt into one package.
Right. Made things easier.
They argue NAV lending is doing something similar, but at the fund level, offering a more flexible, maybe more scalable, and potentially cheaper way to get capital compared to other options the fund might have.
So more efficient capital structure for the fund itself.
Potentially, yeah. They stress that discipline is still crucial, but used right, these loans can help managers deploy capital better, maybe boost returns, without excessive dilution or tying their hands with really rigid covenants.
So the bottom line is it's another useful tool in the PE manager's toolkit for managing their portfolio more dynamically.
Exactly. More options, more agility, more efficiency. That seems to be the core value proposition.
Okay, so for everyone listening, let's try and boil this down. The key takeaways from our deep dive into PE NAV-led lending seem to be, yes, it offers real flexibility, potential for better returns. But you absolutely have to understand the mechanics, the risks, especially valuation risk, and the fact that different people see this differently. LPs, GPs, lenders.
Which leads to, I think, a pretty critical question for those LPs and asset owners listening. Given that this is clearly growing, and we've talked about the potential benefits, should the stance maybe shift?
Shift from just NAV loans, good or bad.
Right. Maybe away from a blanket, yes or no, and more towards a nuanced look at each specific situation. What's the money for? How good is the manager? How strong is the underlying portfolio? Is this specific loan structured well?
Focus on the specifics, not just the label.
Exactly. And thinking longer term, what does this tool really mean for the future shape of the private equity industry? How will it change things? Definitely something worth mulling over, digging into your own sources, and considering against your own investment views.
Absolutely. Lots to think about there. Well, thanks for joining us for this deep dive.
My pleasure.
Until our next exploration.